Between now and then, I'm suspecting you got several months of arm wrestling decline. Now, there's some levels below the market, but they're down there. You're not threatening them right now. So I don't think there's any near-term jeopardy next couple months of anything like a crash in the stock market. Now, you get a little closer to the election, yeah, maybe. So gold, I don't think is threatened by that phenomenon again. And between now and the next couple of months, I strongly suspect gold's going a lot higher, and silver and miners especially a lot higher. But I think we're in the acceleration phase, meaning that part of the bull market where most of the bull market gains of the entire trend at 8, 9 years, in this case, we're 8 years old as well, will be compressed in the final year of the move. Most of the drama, most of the percentage. And I think we're at that, we've crossed that line now. I think we're entering the acceleration phase.
Gold prices experienced a modest decline on Monday, with many traders remaining cautious ahead of key events later in the week, such as the FOMC monetary policy announcement and the release of U.S. employment data. Amidst this uncertainty, volatility is expected to be limited until Wednesday afternoon, when the U.S. central bank's decision is revealed. MichaelOliver from Momentum Structural Analysis expresses confidence in gold's resilience and foresees further upward movement, especially in the coming months. He also highlights the notable gains made by silver and mining stocks since February, underscoring their potential for continued growth compared to gold. Reflecting on historical price movements, gold's performance during significant market shifts, such as the dot-com bubble burst in the early 2000s and the aftermath of the 9/11 attacks, gold demonstrated steady appreciation during these periods of uncertainty. According to Oliver, during the last bull market from 2001 to 2011, gold followed a challenging yet significant upward trajectory, characterized by periods of consolidation and intermittent dips. From August 1999 to August 2011, gold surged from $394 to $2,066 per ounce, marking a remarkable 425% increase over 145 months in inflation-adjusted terms. Despite ongoing economic uncertainties, from November 2015 to May 2020, the price of gold steadily rose from $1,146 to $1,726 per ounce, representing a 55% increase over 55 months. Contrary to expectations of an imminent market crash, Oliver argues that while there may be downward pressure in the stock market, a significant crash would likely necessitate several months of decline. Gold surged by $25, while the Dow plummeted over 600 points at the opening. Since the start of Q2, stock markets, particularly the S&P 500, have experienced a decline of just over 5%, contrasting with gold's significant 12% rise following a major breakout. Come along as we explore MichaelOliver's valuable insights. Don't miss out on our latest updates. Subscribe to our channel and activate notifications. Thank you for tuning in.
That was a point I made in the weekend report. What I did is I showed a monthly price chart of gold during the last bull market from 2001 to 2011. And it was a laborious 8-year process up through about 2008, where you'd go up, nice advance, and then you'd spend a year or more going sideways with dips, just bore the heck out of you. And finally, in that October 2008 sell-off in gold, which was sympathetic with the stock market crash. By crash, what I mean is something that takes 30% off of a market in a matter of 2 weeks. Okay, that's what happened in 29, happened in 87, and in October of 2008, the S&P was already a year off of its high, had been declining for a full year, while gold had been going up, by the way, during that time. And during that, basically late August, early September, and especially October of 2008, there was this crash type event in the S&P. And sure enough, gold had a sympathetic drop, though it had been opposite the S&P for the prior year. So, but anyway, it did have a sympathetic drop. And it was one, when you look at the price chart of gold back then, there had been a range. It hit 1,000, backed off, hit 1,000. These are all-time new highs now. And it was July of 2008, before that drop, you hit 1,000 for a second time. And then that pullback finally sold off enough to where on a price chart, you finally took out a prior prominent low. First time in years that gold had a sell-off that actually took out a prior low. So in effect, it had a cleansing drop. As soon as it finished that drop, boom, back to the highs. Okay. Meanwhile, S&P continued down until 2009. Very similar thing happened between 2020, 2022. You come up to 2070 price level, backed off, came back up to 2070 again in March of 2022. So you, again, back up to the high for the second time. And it was the pullback from that March 2022 high that finally got out of control in when? September, October of 2022. And you took out a bunch of prior lows, just like what happened, like you said, in 2008. As soon as you did that, boom, you're back to the highs. So it was a fake out. That was a cleansing drop that was similar to the 2008 debacle. It was over with so fast, if you were on a long vacation, you missed it. Okay. Everybody seems to think we have to have another one. Why? You just had one. Okay. I don't think the stock market is about to crash, by the way. I think the stock market, if it's going to crash, which I think is a possibility in this bear market, doesn't always occur in bear markets, stock market doesn't always have a crash. Dot-com bubble never had a crash. Okay. It's going to take some months of downside arm wrestling in the stock market before you finally get it to levels that could generate a sharp, rapid sell-off. Between now and then, I'm suspecting you got several months of arm wrestling decline. Now, there's some levels below the market, but they're down there. You're not threatening them right now. So I don't think there's any near-term jeopardy in the next couple months of anything like a crash in the stock market. Now, you get a little closer to the election, yeah, maybe. So gold, I don't think, is threatened by that phenomenon again. And between now and the next couple of months, I strongly suspect gold's going a lot higher, and silver and miners especially a lot higher. And as you noted, if you go back to the February low of this year, look at the gain that silver's had from that low to the current price, even though there's been a recent pullback. Look at the percent gain in the miners from the February low to where they are now. And look at the percent gain in gold, and you'll find gold is much less gain on a percent basis than those two subcategories.
Oliver parallels previous bull markets, noting that silver tends to outperform gold dramatically in the late stages. He anticipates an acceleration phase in both metals, particularly silver, which could lead to significant gains quickly. As of Monday, the price of silver opened at $27.20 per ounce, down 1.33% from the previous day's price, but up 13.68% since the beginning of the year. The 52-week high for silver reached $29.80 on April 12, 2024, while the 52-week low dropped to $20.69 on October 2, 2023. The gold-to-silver price ratio stands at 85.73. Oliver also mentions a similar trend in the performance of mining stocks compared to gold, suggesting a breakout in favor of miners. Notably, top gold miner Newmont Corporation led Thursday's S&P 500 leaderboard, surging 12.5% to a 9-month high with strong volume after exceeding estimates for Q1 adjusted earnings and revenues. Let's get back to the interview.
We measure silver versus gold a different way than other people do. What we do is we divide the price of silver into gold. And if you do that, silver right now is just below 1.2% of the price of gold. If you ever close a month, frankly, if you close a week, in our opinion, about 1.21%. So not far above where we've been laboring the last several weeks. You're going to break that spread out. Now, what I mean by breakout is this. If you go back to 2020 high, when silver vastly outperformed gold in that surge, there's been a relative performance staircasing downside action on that spread, where silver's been losing value relative to gold. But you can plot it. It's a beautiful trend line. It's like a 5-point rally trend line. You hit the line, you back off. And so we're now pushing to try to get through that line. You do the same thing with GDX, the miners ETF, versus gold. You have the same sort of declining pattern since the surge in 2020 when miners beat gold. It's already breaking out with this month's action. So we think that that's going to be the final signal that tells us that, yes, we are in the acceleration phase. Because you go back and look in that late 2001 to 2011 bull market in gold and silver, it was in about 2010 that silver beat the pants off of gold. It just suddenly erupted and went to $50, from like 20. So it was not only acceleration in both metals to the upside, but at that point in time, in the final year especially, and this is true in 1979 to 80 as well, which was the tail end of that bull market, silver vastly beat gold. So while it might have bored you during much of the bull trend up through 1979 or up through, let's say, 2008, where silver was sort of keeping pace with gold, but really wasn't beating it. It was in the last year that silver went electric. And we're at the threshold of that right now. So anyway, it's going to be an exciting year and probably a lot less than a year to gain most of what I see coming. The only lagged metric we have now is what we were just talking about, the spread relationship between silver and gold. Just needs a decimal or so more, and that spread will join and say, yep, silver's going to beat gold. And that's basically our final signal. We think there's other things going on in other markets that are influencing this. And, the bond market, stock market, U.S. stock market in particular, we think it's likely topped out of this recent teasing new high that it made due to 5 or 6 stocks primarily. We all know that story. We think that we got a sell signal the first trading day of April that said, okay, that rally is over. We're rejoining the long-term damage that had been done in early 2022 at prices not far below where we are right now, in fact. So I think that teasing rally to a new marginal high in a few select parts of the stock market's over. Now the process is that way. That will no doubt influence data points, which will influence the Fed. And believe me, they're probably eager to start cutting. They're just looking for an excuse. Why? I'm not going to allege political bias on their part, but I've heard from various sources on news programs and so forth that the Fed governors definitely don't want a Trump victory. If all of a sudden that's not the case in the months prior to the election, which we suspect technically will not be the case, then that's going to hurt them. And Trump has already said he's going to fire Powell. So now, again, let's get off that subject. The Fed just needs some data points. Now, we saw one last week, GDP, vastly lower than expected. All you need is like a change in the employment numbers.
The gold price, which had surged earlier in the week, saw a significant retreat to $2,337 per ounce by Friday. This pullback followed the largest one-day drop in 2 years, marking a correction phase after 2 unsuccessful attempts to sustain above $2,400 per ounce. Despite this correction, there remain upside factors that could again drive prices. What potential upside factors do you foresee that could drive prices higher again shortly? Share your perspective in the comments below. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.